So just to kick things off, I'm going to talk about what's driving our markets at the moment, as well as the view from the world. So what's happening in the global markets and how is that going to affect UAE equities. Basically, credit markets really are leading the way for what's happening to our markets here at the moment. And the UAE economy is going to play an integral part in finding our way through this crisis, and we'll explore a little bit about how that's travelling at this point in time. Corporate earnings, of course, is the thing that's often forgotten when the markets concentrate on doom and gloom, and when we're reading the papers from the UK and they're talking about bankruptcy and this and that. So we're really keen to hone in on where the companies are in terms of their earnings cycle. And everything trades relative to its stock valuation. So we'll look at PEs and price to book ratios and how that compares historically in the UAE and also against other markets around the world. By sector, banking and property, the two key sectors here. Our preferred stock exposures for the coming 12 months in order to benefit from the market going up and shield against it going down. And also the pockets of dividend plays that are presented in the immediate term with the result season coming up now. And then finally where the market's going over the course of this year. So to start off with, what's driving the UAE markets, very much driven by what's happening on the credit side. So obviously announcements regarding Dubai World and other Dubai government-related entities are going to play a key role in where our markets go over the next, at least the very short term, if not the full year. So they're really the catalysts. I mean, local earnings, as I mentioned before, are going to play a key part in distinguishing exactly how much this market needs to price in terms of risk, and whether there's any opportunity in terms of where the index is trading at the moment. Oil prices are high, and the futures are suggesting they'll go higher towards the end of the year, which is a positive support for UAE markets. The correlation between oil and the DFM exchange is 0.8, so that's very strong. And also plays a role with the fiscal surpluses around the region, which helps fund a lot of the infrastructure and property projects and injecting stimuluses into the local economies. Forced disclosure and transparency is going to be a term that I think will be banded around quite a lot this year. I think that the UAE's had to learn, unfortunately, the hard way about disclosure and transparency, and these are two key words that will need to be enforced on all businesses and companies in order to obtain credit internationally and domestically going forward. So I think that as the corporate cycle here evolves in the UAE, and things like the DIFC bankruptcy laws, active housing foreclosure laws, the new central bank circular that's proposed to increase banking provisions across the board, are all things that are really aimed at reducing the risks in the local economy and making sure that the businesses have an active framework with which they can operate with confidence and feel that they have regulatory support. And of course, global markets is something I'll touch on in a second. So where are we at the moment? You see this graph on the left is the DFM index, and you see how at the beginning of 2008 we're up around 6,000 levels. So it feels a long way in the distance, 6,000, with it trading around 1,670 at the moment. But you'll notice just how much volumes have decreased during that time, and even during 2009, you see the bar graph in the red. The volumes really picked up, and I think broadly, locally and internationally, investors realise that the markets here do hold some value, and we're perhaps just looking for greater confidence to take it above these levels. And you notice every time that the volumes increased and the market increased, an announcement will come out or a new development will come out to drag that market back down. Once again, late last year we had the same phenomenon occur prior to Dubai World announcing its debt restructuring. So I think that there is a recognition that around 1,600 levels these markets are becoming attractive, and it's a matter of timing our entry points to take advantage of the upside. So in terms of global markets, I'll touch briefly on this. The world is looking a lot brighter in 2010. Basically, all of the consensus forecasts from economists is for positive GDP growth and private sector demand really picking up the slack once fiscal stimulus packages are wound down. US unemployment is forecast to reduce again, with small to medium enterprises being the key driver there. There is a lot of government debt issued by the US at this point in time, so the money supply will add to the inflationary pressure, and that should increase interest rates in the US and lead to a stronger dollar as well. So what does that mean for our markets? If the dollar's weaker now and it's going to strengthen over the next 6 months, then all else being equal, you're making money for nothing on your investments in the UAE. US equity valuations are perhaps looking a little overvalued at this point in time. The 3 standard deviations above trend. And in terms of China, the government's, you may have read, has moved recently to prick the asset price bubbles on the property and stock market side there, which I think is a responsible thing for the government to be doing. But inevitably, as part of that, we've seen a pullback in Chinese equities and also a slight reassessment of emerging market risk. In any case, I think that these markets, providing that some of these credit developments can work through the system and give us greater confidence in the regulatory framework, we may see emerging market funds switching some allocations to the GCC, and I believe this has already happened in the case of Saudi and Qatar. Unfortunately, UAE has missed out in the short term, but money has a short memory when it comes to potential upside. Commodity prices likely to remain high, good for oil, and also gas prices is an interesting one at the moment. Late last year there was a large valuation gap between oil and gas that was subsequently reduced, and gas as an alternative is a very strong from an environmental point of view, and also large gas reserves in this region, so I think that Dana gas gives great exposure to that. So credit markets, what's happening here at the moment in Dubai, estimates vary from between 85 upwards to 110 billion US dollars is owed by Dubai government related entities such as Dubai World. The ability of them to refinance and repay that is obviously crucial to the growth story here. And the factors behind that really are local GDP growth, what's happening with population, corporate earnings, and of course foreign appetite for the debt here. So these are things we'll discuss briefly. In terms of restructuring of Dubai World at the moment, the consensus is that investors will have to take anywhere between a 30 to 40% reduction on the value of their outstanding debt from Dubai World. So this is really overhanging the credit markets here at this point in time. And I'll just reiterate that I think the equity market here is going to track these credit market developments as the news comes out. So what we're looking for really are potential catalysts on the downside and on the upside, maybe some more downgrades on Dubai and Abu Dhabi GREs by Standard & Poor's and Moody's and Fitch and whatnot. Proposals on the restructuring of Dubai World, the feedback from the creditors, and also asset sales. Remember that Dubai World does have some room to move on selling down its asset positions. Its IFMA was a so-called ring fence from any sell down, but in reality that they may have to sell down some of their stakes as well. So that's where we are in terms of the credit markets at this point in time. You'll see the credit default to swaps for Dubai, which is basically a measure of how you can insure your debt. So if you take out a loan of $1 million to insure, if you lend that to someone, to insure that loan, you need to pay basically $46,000 to insure it. So Dubai is one of the highest credit default swap rates in the world. It was got up to 10% at one point early last year. So international creditors are really factoring a lot of risk in these markets. And you'll see the trend has come down a little bit since Abu Dhabi bailed out Dubai World. So what can we assume as investors for this year, and what do we assume as part of our valuations that we give